Okay, welcome to week 2. I've changed up the slide design for you. I'll try to do that every week to keep things fresh and fun. I want to talk a little bit about this week. We're going to talk about audit evidence, audit risk, and financial statement assertions. So I want to draw your attention to the definition of audit risk. Audit risk is the possibility that an auditor may unknowingly fail to modify their opinion on financial statements. So I want to just give that some context. It's not that an auditor, and of course, let me bite my tongue here, that they would unknowingly fail to modify financial statements that are material misstated. So, and we've talked about the definition of material misstatement several times in lecture, so I won't go over it too much, but the idea that you're going to let something slip through that is going to make a big enough decision on the end user that they end up having incorrect information to make their decision. So in audit risk, they have different types of opinions, and an unmodified or an unqualified opinion is kind of like the go-to, like everything looks good. And so the audit risk would be that you went in and issued an unmodified, unqualified opinion, and you said everything was a go, when in fact there's a big material departure, usually if we're using this from GAAP, if we're using our normal type of criteria. So for those reasons, you have to go out and get enough evidence, and you have to do enough checking to make sure that you don't let something slip through, or at least reduce your audit risk from high to low. So the audit risk also refers to every single type of risk, and we're going to talk a little bit more about that. I don't want to explain the whole wheel on the first slide. So let's look at the financial statement assertions regarding audit risk. So there are assertions that you make, and those are that without regard for control, that have a chance of containing misstatements. All right. So now we're getting into the heart and meat of this particular class. So you make assertions that the accounts balance, the accounts with balances, the accounts, your general ledger accounts, actually exist. That these balances are the events regarding or related to these balances have occurred, and that you have presented all the proper disclosure within your financial statements that you need to make in order to inform your audience. All right, so those are the assertions. So those are relevant, and you'll notice up here they talk about without regard for controls, and I'm just gonna circle. You know I love to circle stuff. All right, so the idea is that not looking at the control situation, that these items, you have a reasonable, you're always going to have a reasonable possibility of containing a misstatement. And you have to kind of have to watch for that. And again, this definition is also in your book. And this particular item is something that you really have to kind of study and wrap your mind around. Now, so in your book, they talk about the objectives consistent with the approach on assertions, and this kind of matches everything that's with the financial statements and the Auditing Standards Board. The only difference is they have one more over here on accounts, and it's presentation and disclosure. So that's the difference between PCAOB and then the Auditing Standards Board. So here are the items that you look at, the assertions. First off, you assert that the accounts exist and they've been recorded as they have occurred. That the company actually holds rights and obligations. So rights and obligations refer to assets and liabilities. So you assert that the assets that you're laying claim to are yours, and that the obligations that you have all been disclosed. You're not hiding obligations like off the balance sheet. Completeness says, hey, I recorded everything in a manner in which it was supposed to be recorded, and I did it completely. And then valuation and accuracy means that everything has been included in the financial statements at the amount that they said it was going to be. So that is your financial statement. Okay, so now I wanted to look really quickly at the combined assertions because there's so many here in the text between the two places. And again, I kind of went over this in the previous slide. Cutoff is one that I didn't hit in the previous slide that I want to hit now. And cutoff says that you've recorded the transactions in the period that they were supposed to be recorded in. And I have a story involved with this. I used to work at a car dealership. I was a dealership account for a little while. And there was always that whole thing that if you got a sale in and you could record it by the end of the month, that if you walked in the very last day of the month, the car salesperson would give you a deal because they're trying to get in before the cutoff. So whenever you make a sale, particularly with regards to recording a sale, there has to be a certain performance involved. And that's where this cutoff comes into play. So I specifically worked at a dealership as a controller, accountant, chief bottle washer, everything, right? I went and bought a car a couple years later, and I noticed that I was at a different dealership, and they told me, of course, I went in the last day of the month to try to get the best deal because I knew the little trick. And they told me, oh, hey, if you make your decision even by the 2nd or the 3rd of next month, we'll still give you the deal because we could record it on the previous month. And in the back of my mind, of course, I didn't say this because it's not my problem, but I was thinking, ooh, cutoff, this is a cutoff violation. And it was. So when December 31st rolls, all the sales are over, even the ones that are in transit, unless they have been shipping point, which is a review from your chapters earlier. Shipping point means that you own it and when it leaves. So you really have to watch the cutoff. So I just want to tell you all the story involved in it. And then valuation. Did you evaluate it at the correct amounts, allocation, accuracy? Valuation might come into play on things like accounts, inventory accounts, because that's where, if you've ever been in the stores around January when they go in and do all those inventories, it's usually Regis that does the counting. They bring in third parties to count inventory. That's how they go in and value the inventory. Inventory may have to be written down. These are reviews from your intermediate accounting. And then last but not least, presentation and disclosure has become very important in the last 20 years. It used to not be as much disclosure as there is now, but it's very important that things are properly disclosed. In fact, that's okay. So here comes up an important slide: audit risk. And I wanted to talk to you a little bit about it because this was one of the hardest things. I don't know why I had such a hard time when I was in my auditing class. Now I look back and I'm like, it wasn't that rough. But anyway, audit risk is the risk of material misstatement, all right, and the risk of not detecting that material misstatement. It's composed of those two things, all right. Within the risk of material misstatement, there is inherent risk, the risk of material misstatement that has nothing to do with internal control. And then control risk, the risk that an assertion will not be prevented or detected on a timely basis by the company's own internal control. Now, here is an example of an inherent risk. An inherent risk would probably come up in a particular transaction that is very complicated. So we're going to be doing some work on Enron down the line in the last 2 weeks. We're going to be writing quite a bit about that in our discussion boards. And I really want you to take on the Enron and think about, if you were an auditor walking into that particular business, would you not sniff already the complicated nature of that business? The other one is if you have a large a type of industry that involves risk of theft. And I'm just thinking, and I looked this up, so I did a little cheat, but I remember specifically businesses that have cash handling and large amounts of cash. So check cashing, casinos, banks, anything that has a large amount of theft, heavy cash. That would be a company that has more inherent risk than, say, a salt mine or a paper mill. Okay. Control risk is the risk that controls are going to be compromised by the company's own internal auditor. So some examples of control risk would be someone who is wearing every hat at the company, like an administration assistant that wears every single hat. They also pay the checks, they balance the checkbook, they write the checks, they settle the accounts payable, they settle the accounts receivable. There's no separation of duties. Everybody has their pots, no hands in every pot. People aren't using passwords. There's like tons of reasons for control risk. Detection risk is the risk that the procedures. So this is the one risk that the auditors can control. They can't control inherent risk. They can't control the company's control risk other than saying, oh, you don't have any. But detection risk is something that the auditors are responsible for. So they're very concerned about that. And that's the risk that your procedures, what you do, will lead the company to conclude that a material misstatement does not exist when in fact there is a misstatement out there. So that is how audit works. Now, here comes the math. Did you think we weren't going to have any math in this class? I hate to disappoint you. Actually, you might even be disappointed, like, oh, I was really looking for math in this class, and now there's no math. Actually, there is up to lectures. All right. So here's the audit risk formula. This is something all of those who are getting ready to sit for the CPA, remember this formula. Write it down. Review it in those 2 or 3 hours before you walk in. Audit is done. Write this down. Audit risk is inclusive. All three of these things multiply together. Inherent, control, detection. Which one is the auditor responsible for? Let's do a little review. I remember specifically in one of those samples that we had. I mean, I don't know what happened on my last slide, but I'll say this again. Auditors are responsible for detection risk. That's the one item that they can control. Now, this little sand illustration from your book, I just thought it was delightful, and I wanted to share that with you too in the slide, and of course it's in my slides out too, so I'm very excited to see it. I love, I look back and I'm like, man, if I had that in my auditing class, I would have loved to do that. So the idea that inherent risk and control risk, inherent risk is kind of like the sand, all right, the nature of the business. Control risk, you kind of put it through the sift, you try to sift it out based, and this would be based on what the company's doing. Is the company doing everything they can? And that's where you go in and test their controls and decide whether or not their controls are enough, that there is something that's kind of sifting it out. All right. Detection risk is where the auditor comes in. The auditor comes in after evaluating the internal controls and the inherent risk and goes out and does some work to detect it, any material misstatement. And then, of course, at the bottom is where the final risk is underlying. You can see how the salt keeps getting more and more basically sifted out. So the audit risk is that misstatements could potentially be undetected, and hopefully they would go through the sift and everything would be correct information. Hopefully you catch it during the first 2 iterations. And that's what audit risk is. A great example of audit risk. If you can't see my slide very well, please go to your book on page figure 5-2, page 150. I'm just a huge fan of that thing. All right, so here again, another illustration of inherent risk is the nature of the client and the environment and the particular financial statement element. So for example, cash is a little more risky than other items. So here's some business characteristics of high inherent risk. Here's one: inconsistent profitability, operating results that are highly sensitive to economic factor. Going concern problem means that they're having trouble staying in business. Large misstatements in prior audits. Once you have a prior period adjustment, all eyes are on you. And then substantial turnover. And in the videos from both Enron and from Theranos, which we'll watch later on in this class, the turnover problem is very much out there. Someone should have noticed that. They never do though. They never. We say, oh yeah, the handwriting was on the wall, but yet somehow it's not all the time. All right, assertions with a high inherent risk involve difficult to audit transactions or balances, complex calculations, different accounting issues. So these are the assertions, not the business nature itself, and valuations that significantly vary based on economic factors. And the one that I'm hopping on right now is, I'm thinking mark to market on stocks, but that's a whole other video. Okay, so types of transactions that you would have high or lower inherent risk would be items that have recurring financial statement activities in the accounting records and are over the normal course of business, usually low inherent risk. Something that's non-routine, so for example, let's say you only write down the inventory whenever you do the physical inventory, that particular transaction might have some inherent risk. And then estimations, when you have to make an estimate, remember allowance for doubtful accounts, that percentage of estimate, you can't just go in willy-nilly. It's high inherent risk. All right, so here are some appropriateness of audit evidence, okay? So auditors must contain appropriate, or must get sufficient appropriate evidence that is both reliable and relevant, all right? And the audit evidence is usually more reliable when it is A, obtained from independent, outside of the company's sources, and rather than non-independent sources. So it's great if you can go out and get it directly from the clients of the firm versus a list of clients and transactions from the internal auditor. So there's a lot of substantive procedures which we'll discuss later. Audit evidence is normally more reliable when it's generated through a system of effective controls. So the audit evidence, so for example, the cash balance in the checking account is more reliable when there's not one person doing the checking account balance and also the deposits. See where I'm going with this? All right, obtained directly by the auditor rather than someone indirectly or by inference, by making a guess. So for example, if the auditor can go out and get receipts for all the cash transactions and actually get the physical receipt instead of having the internal control auditor make copies of the receipts, believe it or not, and then email them to the auditor, it's more, and this is a pretty like rash thing, but receipts have been falsified before. I actually saw it, so that's why I'm bringing up that story. I actually saw it. There were 2 people stealing from the bank that got in trouble, and what they were doing was falsifying some records. And anyway, it happens all the time. So if you can get the originals, that's why everybody likes the originals. Documentary rather than oral, so you want to be able to get it. Now that's changing with all the internet that is going around and all. You could transcript it and record it, then absolutely, and provided by original documents instead of copies, obviously. So that is why. Okay, the overall categories of audit procedures. So what do we all do? We have different things. We've got risk assessment procedures where the auditor goes in and tries to obtain an understanding of the client's business and their environment, including how they're running their internal controls, and also assess the risk for what they're getting themselves into regarding material misstatement. Then, once they get that rolling, then they go in and actually perform the tests of controls to look at the operating effectiveness of the company. Like, is this internal control looking good? Do I trust this company and their controls are in place? Substantive procedures is where you go in and do the detection. That's that detection risk, where you go in and do analytical procedures, tests of details, pulling transactions, trying to substantiate some of the information. So you do substantive procedures. All right, so here are some different types of audit procedures. I just found this slide incredibly interesting. Inspecting documents, inquiring knowledgeable people within or outside the entity. You almost go in kind of like I want to say it, investigative reporter. You know, trying to get the inside stories. You talk to people. How's this boss to work with? How do people follow the rules around here? External confirmation, that would be sending out to the client's own customers some verifications of accounts receivable balances. Inspection of tangible assets, walking around on the floor and looking at the machines and figuring out whether they all exist from the list of assets. Observations of processes and procedures being performed by others. You know, when they count down a cash drawer, do they keep their drawer locked? You know, things, are they doing what they're supposed to do? Recalculating mathematical accuracy, reperforming some of the procedures, and analytical procedures. So it's a super fun job. If you decide this is where you want to go in the world of accounting, you're going to have a blast. The job is always different. It's never the same. And it's always interesting to go to these different companies. Okay. And then, of course, I'll let you read figure 5-3. Very interesting types of audit procedures and examples there. And then let's talk about substantive procedures. So there's several different, well, not really. There's different types of procedures, but there are analytical procedures. That's when you do the ratios. Okay, remember those ratios from chapters 1 to way back in your early intermediate accounting days? I believe I was with this class. If I use this tape again, I wasn't with your class. Just go back and look at the very first chapter. Anyway, analytical procedures are performing those ratio analysis. Tests of details are actually going out and checking account balances and disclosures and so on and so forth. And then you can change the scope by changing the NTE or the net, which is reordered, the nature, timing, and extent of the procedures. So it's basically how deep you want to go into that. If you think you need to do more because you want to lower the detection risk because the other 2 risks are high, then you go on, and we'll talk about it too. All right, so nature is obtaining more reliable evidence, often externally generated, and timing is waiting until the end of the year to look at the transactions, because that's usually when most of if there was going to be a potential issue, it tends to happen at year end. Remember I was talking about that car dealership at the end of the month? That's when okay, so the extent of the procedures is how far you're going to go in to the audit. And everything, nature and timing being held constant, the greater risk of material misstatement, the greater you need to extend your procedures. So if you have a very high risk of material misstatement with your particular area, then you're going to have to do more work. And then the way to extend procedures is just to look at more stuff. The higher sample size, and we'll talk about this in chapters coming up, the more you reduce the risk, the more sample. So let's say I'm trying to find out something about something, and I interview 10 students, and I'm trying to figure out what's, some sort of research item. I'm going to have a better shot at getting the right information if I interview 1,000 students versus 10. And that's the same thing in auditing. Bigger sample size, it will reduce the risk of detection or the risk that you're going to get it wrong. Okay, so the goal of analytical procedures is to basically look for things that would be happening normally that are not happening, or something that is unexpected that isn't in the norm, based on using ratios. All right, and there's a process to do it. Okay, and the process is as follows to develop these analytical procedures. Is you come up with an expectation of a certain ratio. For example, days in inventory. If your inventory is normally 40 days, remember when you guys did all those ratios way back when in accounting class past? Now they get to come into handy. Why were we doing all that? This is why. You determine a difference that can be accepted without investigation. So if something comes out and you say, okay, if we're 0.01% off, or we have a 95% confidence level that this ratio is correct, or if our ratio is normally 7.0, it's, we'll go between 7.0 and 7.5. You just get that degree of confidence with what you will tolerate. Okay, so the next thing is to compare it and see where you landed, and then go out and look at the difference. Okay, so once you, how do you get the expectation going? Well, you look at benchmarks and prior periods. So you would look out if you're supposed to, I think one of the things I did in healthcare finance is it was around 42 days between the time a patient walks into the hospital and the time that the hospital should expect a payment. Be finished paid in full after billing the insurance and doing all the work and all that sort of thing. Somewhere in the neighborhood of 42. Good hospitals were in the low upper 30s. Bad hospitals were really struggling to get paid. Depending, I say good and bad, I mean with relationship to hitting the ratio. Obviously, everybody's under different circumstances with relation to who can pay their bills and so on and so forth. So time to get paid may take longer. So for those reasons, that would be like an industry standard. And then the other thing is to look at the financial information as opposed to the non-financial information, and look and see how that could affect it. Okay, so let's look at the last little bit about the analytical procedures. You could do a trend analysis, which looks at the company's changes over time, and a ratio analysis, which you have all done before. Now you're wondering, hey, now I remember what these were for. That's what you're doing in auditing. Now you know why you do them. Okay. All right. You could use vertical or horizontal and cross-sectional. You can do common size financial statements. This should not be new to you. It should be a review. If you don't remember what those are, please go look them up in your old books. Regression, you can look at regression. You can do, you have lots of fun with it. So here is the type of analytical procedure and the type of misstatement it would find. Very helpful. I'll just do one or two. My favorite one is accounts receivable turnover for the current year to prior years. What it might show is a misstatement of sales or accounts receivable, or a misstatement of the allowance for collectible accounts. So that's a big one. You can just go in and look at the different things in there, and it's helpful. This kind of stuff right here also come up on your standard. Okay, so we look at a credit sale made on December 31st. Look at how the ratios are affected by journal entries. So before the end of the year, the sales to AR was 7.0. 750 divided by 100,000 in AR. 700 divided by 100,000. 700 in sales, 100,000 in AR. And for those of you, remember, this is the numerator, this is the denominator. Just a little bit of math review. When you record a $50,000 sale, all right, it changes. You add the $50,000 to the top and add it to the bottom, all right, and you get a new amount. Your ratio goes from 7 to 7.5. So it does have an effect. Even if you record a revenue sale on 12/31, it does have an effect on the ratios, sales to accounts receivable. So here's the numerators and the denominators of ratios greater than 0. Increasing the numerator, whatever you've decided for your numerator, always increases the ratio. Increasing the denominator always decreases the ratio. If you do them at the same time, it increases the ratio if the ratio is greater than, or decreases if it's greater than 1, and increases if it's less than 1. So what do you need to know out of this? Changes to amounts, numerator, denominator, affect ratios. Okay, so let's talk about my favorite thing, data analytics. Okay, data analytics is the process of using related and unrelated data to provide insights into decisions. And I did a talk in 2016 or 17 about how data analytics was coming to CPA firms. It was right in the beginning, and people were just starting to adopt some of the programs. And of course, I still have that talk out. I'll probably share it with you. It's probably about time I do a new one. But CPA firms are constantly looking at new approaches to improve risk assessment and test controls, and do substantive procedures. And if they can grab onto the firm's data, it really helps them out. And I might be blocking it with my video, but one thing that is super neat is that in tests of controls, data analytics may be able to use 100% of the population. So instead of, because you have everything electronic, instead of going out and looking and pulling, and I remember specifically from my days at the bank, pulling 10 check numbers randomly from a list of cashier's checks, because everything is now online, you can just go into the computer, pull every single check number, put it in an Excel doc, compare to see if it's there. If all your paperwork is online, then you can pull the whole thing. You can do it quickly, and it's super cool. Very, very cool. I like data. Okay, so here is some approaches to accounting estimates. All right, so the estimate is the weakest spot in the auditing process. That's the spot where someone has got to make a decision. And everybody, when you look at like all the papers of research accounting, even when I'm writing for my dissertation, it always comes down to estimates, because that's the one thing that we can't walk back to transactional data. That is somebody's judgment call. And anytime a judgment call is made, that is something that definitely needs to be looked at, and also has the highest risk to the auditor and the manager. Why? Because judgment gets argued in a court of law. So you have to go in and develop the estimate first by yourself, independent, and then go in and compare it to the management's estimate, and then review everything subsequent events or transactions bearing on the estimate. Okay, so let's look at the fair values. And they use the inputs, and there's a level 1, 2, and 3. Level 1 is observable, quoted prices in stock markets. Let's see, level 2 is inputs of quoted prices, generally for similar assets. So it's quoted to you, but it's not right there. And then level 3 is something that is unobservable. So for example, and well, I'm not going to read all these, but you get the whole gist. Anything that you can't substantiate necessarily. Related party transactions, okay? Related party. Now, we just did a whole class on subsidiaries and consolidations, and how everybody owns a little portion of everybody else, and how difficult it could be. It gets very challenging when you deal with parties that are related either through some sort of benefit, either oh man, the list goes on. I can't even begin to tell you all the ways people can be related, but I will say this. I'm just hitting one real quick. A lot of this is parent company and sub relationship. Sometimes it can be employee benefit, and I don't think what they're thinking about is necessarily related parties as far as people with each other. But that could be maybe a little bit, depending on the ownership. The goal of audit documentation is to support and comply with the standards. The secondary function is it assists continuing the new audit. any new audit team members are planning and performing the audit, and it serves as a record of matters. And then, of course, it helps assist the supervisors and review the audit, and it also demonstrates the accountability of the team members. So there to help us. Audit documentation has to be enough to enable an experienced auditor to understand what you did and what you worked on, and identify everybody who did it, the audit work, and show that the accounting agrees with the financial statements. Okay, and then here are our type of working papers. This is what you would use. Again, these are all the different things that you would use. Administrative papers, working trial balances, schedules, analysis, reconciliations, computational working papers, and of course, corroboration of documents. The current files are the files that you're working on right now. The permanent files are items of continuing audit interest. And then here is a nice little graph. You can see the way they have nicely worked this out for you and the working paper. And that is it for the week. Well, not all week, but Chapter 5, Part 1 of the week. I hope you are all doing well at home. I am looking forward to having you all back in class soon and seeing you in PGS Center. Reach out to me. Don't forget to fill out your weekly package for participation. And I'm looking forward to your discussion post this week, and I have a few more chapters for you. Take care now. Thank you.